Hi, thank you for tuning in. In this video, we're going to go over the topic of year-end tax planning. While not the most exciting topic, tax planning is one of the most critical. And at the end of the day, it's all about keeping the most of what you earn. And so by year-end proactive tax planning, this is a perfect time as we get into fall to look at strategies we can be doing to really maximize your wealth and fast track that path towards work optionality. In this video, we're going to go over 7 topics in our checklist for year-end tax planning strategies. The first topic that we're going to hit on is navigating the tax brackets to your benefit. And that all starts with knowing what tax bracket that you're in. And we could go from there on how to best maneuver it. As I show you this chart right here, the left-hand side of the screen is the 2020 tax brackets for a married filing joint couple. And as you can see, as the income levels go up, so do the federal tax rates. The strategies you take is going to depend on your situation. For example, if you have a family with an income of about 350,000, you actually have room in that more favorable 24% tax bracket. And so you may want to be thinking about a Roth conversion or 401k Roth contributions to really maximize that favorable tax rate and use up as much as you can. On the flip side, if your family's earning closer to 450,000, you have tipped over into that higher 32% tax bracket. So that's quite a jump from the 24% that we were looking at before. And so this might be a place where you want to do strategies to reduce your taxes to stay in the favorable 24%. And so it all depends on where you land. And especially now, we have pretty major differences between those different tax bracket levels. Something else to keep in the back of your mind is that in 2026, we're set to sunset back to the prior tax rates, which are not nearly as favorable. There's a couple key danger zones where if your income lands in a certain area, you're going to see a major jump in tax rate from where we are today. So for example, for a family that has 300,000 of income, rather than sitting comfortably in that 24% bracket, you are going to be in the 33% bracket. Same thing goes if you got 250 or 350,000 of income for that matter. And so as we look at tax planning today, we also want to keep an eye on the future as we maneuver around the current tax rates. The second checklist item that we're going to cover is reviewing your contributions to your 401k and retirement account. A lot of folks are saying, gosh, I'm in October, what can I really do? Well, there's still plenty of time to maneuver. For example, if you haven't maxed out your 401k yet, this might be a time to look at increasing or adding to your contributions to do so. And remember, at Microsoft, you are not limited to the 22,500 or 30,000 if you're over age 50 that can go into your Roth or traditional 401k. With the mega backdoor Roth, you could put an additional 32,000 plus in, and that allows you to add even more into your Roth in a tax advantage manner. And so this is a great tool to really fast track your retirement and financial plan. And a lot of you may be saying, gosh, if I add that much more to my 401k, that's a lot to make up in a few months. How am I going to cover my bills and my spending? And there's a couple ways to maneuver that. Of course, if you increase your 401k contribution, that's going to be less hitting your bank account. At the same time, if you have other accounts, such as a brokerage account or Microsoft stock, for example, you may consider selling some of those shares or brokerage investments to subsidize and supplement your bank account and make up for the amount that you're funneling extra in your 401k in a tax advantage way. Because again, it's more preferable to have money in a Roth 401k rather than a standard brokerage account from a tax perspective. So we might as well add more to that favorable bucket if we can, even if that means taking from your less favorable bucket to keep your lifestyle the way you want it. The third tax checklist item that we're looking at is exploring loss harvesting. What loss harvesting is, and it especially applies as the last couple of years have been very volatile, as we all know, as you have investments such as stocks or stock funds, as they temporarily go down during waves of market volatility, you can sell those, realize the tax loss and use it today, and then reinvest the proceeds in other similar investments, or even use that as a chance to diversify into more appropriate investments. For example, in the last month, we've seen some market volatility, right? Even with Microsoft stock. And so many of your August RSU vests, if they're still in Microsoft, are likely down a bit from that vest date. And so that's an instance where you could sell those, capture a tax loss, and diversify into another investment that might complement your overall holdings and risk picture a bit better. Fourth item on the checklist is managing your tax deductions with charitable planning. That first bucket, if you are in that household where you're saying, gosh, how do I reduce my income a bit to get into that more favorable tax bracket? Charitable planning could be a great way to kill two birds with one stone, both reducing your taxes while providing for different charitable causes and passions that you feel strongly about. One real sound strategy is called bunching your deductions. And so what that means is currently with the current tax rates, we also have a really high standard deduction, over $27,000 per family. And therefore, for many, you have to show quite a bit of charitable giving to really get credit for the tax deductions and get your itemized deductions up to a point where it exceeds the standard deduction. Because between property tax and mortgage interest, you likely are not there alone. So you may have to donate quite a bit to really get into that itemized deduction bucket. And so by bunching, you could use a tool such as a donor advised fund, where you may put 3 years of charitable contributions in there at once. For example, if you give, $10,000 to charity each year, you might put $30,000 into your donor advised fund. When that $30,000 goes in there, you're able to itemize it and deduct it for tax purposes. And then from there, you can disperse over the next 3 years to the charities of your choosing. So 10,000 next year, 10,000 the following year, 10,000 the following. And so this is a great way to bunch up and get the tax benefits of doing a larger contribution at once, but still dispersing to the charities with your overall intention and goal. Another real neat feature of the donor advised fund is that you can fund it with appreciated stock or investments. So that's a bit of a double whammy where not only do you get the tax deduction, but if you contribute appreciated Microsoft stock, for example, you don't pay the capital gains, nor does the charity on that appreciation. And so that's a great way to avoid a lot of accumulated taxes. And also doesn't mean you have to come out of cash in your pocket to make the charitable contributions of your choosing. The fifth item on the checklist is leveraging the gift tax exclusion. As many of you know, in Washington, we have an estate tax that kicks in at $2.2 million per person. And federally, while the estate tax threshold is really large right now, it is set to cut in half in 2026 and reduce from north of 12 million, 13 million per person to about 7 million a person. And while still a big number, it's always important to get ahead of estate tax planning. And it's a good way to not only help out family and those that you would like to aid, but also reducing and minimizing future taxes as you go. And so the way it works is you could give $17,000 to any recipient, any beneficiary as your annual gift tax exclusion for the year without reporting it. They don't have to report it. There's no taxes attached to it. Free and clear. As a married couple, you can do combined $34,000 to any recipient. And so that could be a really strong way to help out your family or different family members that need it or that you want to assist, or reduce your estate taxes down the road without having to be burdened with any administrative tax reporting or potential taxes as a result. For many, you may be saying, gosh, that's a lot of money to give to my children each year. They may not be ready for it, or we just may not be comfortable with that level. And so another technique is in certain instances, you can gift to a trust for the benefit of those family members and still have the ability to control the funds as trustee. And so that's a way to do the gifts, get it out of your estate for tax planning purposes, while still not handing over the reins per se at a point when you may not be ready. a little bit nuanced, so feel free to chat with me or ping me on that one if you want to talk about it for your situation. To round out, the sixth checkpoint item is watching out for tax surprises. As we mentioned before, your RSU vest, restricted stock units, the federal requirement is only a 22% tax withholding. So we see it all the time where Microsoft professionals are not withholding enough tax on those, and it results in a big tax surprise come tax filing season. Additionally, with interest rates going up so much, this is the first time in 15 years where we've had 5% plus return on your savings and cash savings investments. While that's a total home run, that also means you got to be mindful those income and those gains on those investments are taxable each year. And so that's one that's going to sneak up on quite a few folks as they're not accounting for the interest they're earning on their savings. The way that you watch out for tax surprises is putting together a tax projection with your planner. And that way you'll have a map towards how you're lining up with your withholding. And if there's anything you need to do over the coming quarter to adjust and prepare accordingly to avoid a tax surprise and a possible penalty and interest hit. To round it out, last checklist item is plan for 2024. We currently are entering open enrollment periods where you need to elect for next year's deferred compensation plan contributions. So this is a great time overall to just map out what the next year looks like. And if there's any actions now or in the coming months you want to do to prepare for and complement that. And so those are the 7 items that we're covering in our year-end tax planning checklist. I'll give you a quick visual that goes over those that we just covered together. This is a time of year to buckle down, go through that list and map out any activities that you need to do. I know a lot of this can be a bit daunting and overwhelming, and this is what we're here for. So don't hesitate to reach out to me, shoot me a LinkedIn message, an email, contact us on our website, and we'd be happy to help you navigate these strategies. But remember, the key to tax planning is being proactive and forward-looking rather than reactive. And it can absolutely shave years off your work optionality timeline and make a massive difference in your overall wealth that you end up keeping. So something to really focus on as we round out 2023. Thank you so much for joining. We really appreciate your time. I hope you found this video helpful.